This week, our guest is the famed James Grant, founder and editor of the highly influential market journal, Grant's Interest Rate Observer. Simply put, Jim is one of the most respected market analysts and historians on the planet. So when an expert like him says that today's markets are at one of the highest and most dangerous levels of speculation in history, we'd all better be paying close attention. Why does Jim say this? You're going to have to watch this video to find out. Oh, but before you do, please take a second and click on that like button to help us continue the parade of amazing guest experts we've had on this program. Because the more likes these videos get, the more big names we're able to attract. And so now let's get started watching this week's market update featuring James Grant. Hi folks, Adam Taggart, co-founder of Peak Prosperity here, welcoming you back to another week of trying to make sense of these markets. And folks, I am extremely excited for today's guest. And you can see I'm honoring him by wearing my bow tie, which I can't believe I remembered had a tie after decades of the last one I'd ever tied. But you already figured it out. Today's guest is Jim Grant. He's the founder and editor of the highly respected market journal, Grant's Interest Rate Observer. A historian and author, he's authored a number of books on finance, economics, and politics, which make him a highly sought-after expert who's appeared on 60 Minutes, the major nightly network news shows, the Wall Street Journal, even garnering him a positive shout-out in Michael Lewis's The Big Short for his warnings about the excesses that led to the 2008 great financial crisis. Jim, we're so honored that you're making time to speak with us today. Thanks so much for coming on the program.
Well, Adam, you're entirely welcome.
Well, it's such a pleasure. Jim, let's just get started right away. As I like to do with our guests, without introducing any of my own personal biases, could you just tell us what is your assessment of today's financial markets, speaking to their integrity or just however they strike you?
Well, they are very, very spirited. Up seems to be the prevailing direction. And I'm reminded a little bit of an old tune, and the lyrics of which go something like, "It is only a paper moon sailing over a cardboard sea," and the paper moon and the cardboard sea would connote to me the massive federal intervention into our economy, and particularly the monetary side. That's not to downplay entirely the irrepressible spirit of American enterprise and the wondrous efforts of scientists uncounted worldwide to deliver us a vaccine to spare us of this plague. None of the good things, I don't mean to diminish at all. What I do mean to emphasize that we have never seen anything the likes of today's monetary intervention, and that intervention must account for a great deal of this, what's the word, I guess, zooming to the upside. It's quite remarkable.
And I don't want to lead you here, but as you say, use terms like remarkable, and you talk about the great intervention. Does that make you concerned about where things are headed? Is this sustainable, I guess? Should we
well, yeah, a little bit. I in a way, I come pre-concerned. I have a skeptical outlook on the world, I suppose, and I am inclined to look first at risk and secondly to reward. But I am concerned. Yes, I'm also fascinated and intrigued by things we have never seen before. We have the lowest interest rates in 5,000 years in the authority of a book called The History of Interest Rates, which, Adam, I suspect you have by your bedside, but you must open it and read it in addition just possessing it. And we have...
I read it all the time.
And we have... we have 0% interest rates at the short end. It's kind of a new thing. It's not unique, but what is unique, as well as the lowest rates in 5,000 years, is the institution of nominal yields, that is to say, posted in your newspaper bond yields of less than zero. They pertain mostly in Japan and Europe, and still they do bear on our markets as well. And we have another thing, which is free equities trading. So if you add up free stock trading, no interest rates, you come up with a pretty powerful indeed unprecedented instigation to speculate. So what we are seeing is savers becoming speculators and speculators becoming day traders. So that it's a terrifically exciting and speculative and frothy environment, and there's lots to like about that. I myself prefer the value-laden opportunity presented by despond at low prices. It's a personal preference. But this is one of these episodes that we'll look back upon and say, oh yeah, wasn't that something? It's fabulous. It is a boom. One can argue, and one, I suppose, will argue about nomenclature. I would say it's knocking on the door of a vast bubble, but I don't mean to say it's not fun.
Okay. Well, we've seen. We have a number of people who watch these videos who feel like we have seen this movie before, even in relatively recent memory, both with the housing boom leading up to the great financial crisis, and then with the dot-com boom era before then.
Oh, sure, yes, yeah.
The booms are always fun. It's the hangover of the bust that's always, the painful thing that nobody likes to go through. So your answer there just sparked probably 3 or 4 questions in my mind, Jim. But why don't I start with this one? Because you wrote a really great piece in the Wall Street Journal back in April, I think, called "The High Cost of Low Interest Rates," and in it you sort of expound on the damage that persistent rock bottom interest rates can have in terms of goosing asset prices, perhaps to unsustainable speculative highs, or encouraging excessive risk-taking or malinvestment. Historically speaking, how bad is what we're seeing right now compared to other speculative bubbles? I mentioned some recent ones. You're a historian. You know a whole bunch of these.
Well, it's way up there. I would say this is at the extreme level of misdirection through interest rates. Imagine that interest rates are they are prices, but imagine that they are like a kind of traffic signals directing investment and the allocation of savings generally. And if you turn all those traffic lights green, what you find eventually is pileups at the intersections and a lot of work for the body and fender shops. We haven't seen, we have seen some of the pileups. We are invited to imagine them on the basis of what has come before us in financial history. As long ago as the 1850s and 60s, there was a British thinker and doer about finance. His name was Walter Bagehot, and he was kind of the godfather of contemporary central banking. And Bagehot, alluding to the national symbol of Great Britain, said, John Bull can stand anything, but he can't stand 2%, by which he meant that very low interest rates instigate the misallocation of savings and the speculation and things that one wishes later one had not speculated on. So he meant positive 2%, did Walter Bagehot, and today we have, some ways not quite minus 2%, but the point survives the exaggeration. We have 0 and sub-zero rates the world over. The two, I suppose, of more than $15 trillion worth of bonds that are priced to yield less than nothing. So what does this mean in real life? Well, if you want $50,000 a year as savings, and if rates were 5%, $1 million would deliver that $50,000, 5% of $1 million being 50,000. But if the rate in question were 1/2 of 1%, or 50 basis points, you would need, what, $20 million to generate. Is it $20 million? Wait, I look like Joe Biden. No, you would need $10 million. The witness checked his prepared text, his notes. $10 million gets you $50,000 at an interest rate of 1/2 of 1%. So that means that paradoxically, rather than stimulating consumption and activity, in many ways, low rates stimulate the opposite. They force people to lay aside more to generate the same income because you need more capital. You can think of this as kind of a hyperinflation in the cost of retirement. And when rates get very, very low, as some of the bond bulls hope they will, you need much more than 10 million. You needed at 25, 1/4 of 1%. I think you need, what, $20 million. So it's And and low rates perpetuate the unwarranted lives of companies that really aren't making it. We call them zombie companies, and they don't quite earn enough to pay off their interest rates, their interest charge, but the banks are accommodating, the bond markets are accommodating, they get more debt, they pay off some more interest expense, and their lives are perpetuated. But because they live, new companies with perhaps better ideas, more dynamic management, they don't come into existence. So, these very low rates contribute in a way to kind of a molasses effect in our economy. It's a visible lack of dynamism, and has been in place for the past 10 or 12 years. So low rates are not everything they are cracked up to be.
Wow, very well put. I'm going to ask you a question I actually hadn't prepared, but so low rates act as this molasses on the economy, and you said they resulting in a sort of a hyperinflation in the cost of retirement, right? That people that previous generations who would expect to be able to retire on a fixed income based upon their savings, they now need to save an awful lot more to be able to get any sort of real income off of that savings. And the question that I have here is, there's a big wealth inequality gap going on right now that these low interest rates and Fed intervention is exacerbating. Right. But there's also, and this is the question, because of this hyperinflation of the cost of retirement, you're seeing this big divide in advantage between people who are on a pension and people who aren't. The people who saved are now getting much less off of those savings. But people who are getting a pension, it's almost like, if you're getting a $50,000 pension, that's what, by your math, like having $10 million in the bank, right? So I'm just curious if you have any sort of thoughts that, are we going to see an additional sort of social tension between people that are getting a pension versus people who saved the old-fashioned way and are now getting disadvantaged because of these low interest rates?
Yes, I think there is a kind of an envy vector at work in our investment markets in many ways. One source of mobilized or weaponized jealousy is, of course, social media. But Adam, you hit on another one with regard to the divide between those on a defined benefits plan. They are getting the benefits they signed up for, and those who are on a defined contribution plan. They get to contribute as much as they can, but they are assured of no benefit. But notice that the assurance of a benefit is ultimately contingent upon the laws of arithmetic and the availability of the promised returns in the markets themselves. In California, you saw recently the chief investment officer, I think it's no longer with CalPERS, he came out and said, what we have to do is borrow money with which to invest in more private equity being a highly encumbered or debt-burdened form of stock investment. It's not the public market, it's the private market. There's a lot of debt involved, right? So in England, the professors, many of them have a defined benefit plan, but lo and behold, the company that's sponsoring those defined benefits is telling them, you must pony up much more of your income, and to the universities, you must contribute much more of the professors' salaries to make ends meet. So the benefits are seemingly guaranteed, but they're guaranteed only to the extent they can be wrested or prized from these kind of begrudging financial markets. And why the markets are grudging is because they have been jacked up so high through many ways, through monetary interventions. So you think so the markets are so high, isn't that great? Well, yes, it's so great if you had been in them, but it's not so great if you are investing in them. Quite the contrary, because your returns necessarily are constrained by the valuations in place. You can't expect stocks trading at 25 times earnings to deliver the same ultimate return as you can, or you could by stocks trading at 10 times earnings. Similarly, in the bond market. So this is a very complicated thing, but Adam, to your question, is this contributing to the astringency of our politics and the resentment in our social lives? Yes, indeed. The Fed denies it. I think that their denials ring hollow, but it's certainly a part of it. I wish people would pay more attention to it. Nobody said anything about this, what's the word, debate last night about referring to candidates debate. They could have dwelled with this. They didn't even touch it, but it's a big thing in our lives.
I think you're being generous calling that a debate, to be honest. It's more of kind of a mudslinging disaster, but
it was, yeah.
So, and we've talked with a number of guests on this program in previous weeks about how, the Fed's policies are leading to, a lot of the social anger that's going on here. And we've said that until people connect the injustice that they're feeling with the Fed's actions, until they do, the status quo is just going to continue. In other words, until they realize the Fed's not the hero of the story, which is the Fed is portraying itself to be.
Yes.
And
Adam,
you've used the term of the arsonist, the firefighter who's being celebrated, even though they're the arsonist that started the fire.
Right. Yeah. This is the yes, and the Fed is this closed system. It's this clerisy, this priesthood, and all the academic economists are pro-Fed, and for one reason, the Fed is the biggest employer of PhD economists in the country. There's many hundreds of them on the payroll. And, Judy Shelton, who was this controversial Trump nominee for a spot in the Federal Reserve Board, has seemingly not got the votes. If she had the votes, the Senate would have voted on her. So she's on the cusp of succeeding or failing in the administration's bid to place her on the Fed. But her view is that, the dollar, for most of the history of this country, was defined as a certain something, weight of silver, weight of gold. In any case, it was defined in law as a thing. And since 1971, the dollar has no longer been that thing or derived from that thing. It has been whatever we collectively agree it is, more particularly what the central banks mean to produce in the way of the quality of dollars and what the markets choose to value that currency. Oh, this is a complicated way of saying the dollar is lighter than air. It is immaterialized. And we don't mind it so much because Wall Street loves it because so many dollars make the markets go up so well. And many, many people on Wall Street owe their considerable, almost dynastic fortunes to this shekel thing of this shekel currency. It is producible seemingly in infinite numbers. I mean, the Fed materialized. The Fed materializes dollars, and some guy sitting on a keyboard. Like I'm not sitting at a keyboard. I'm does like this, and bingo, $1 trillion comes into existence. That's what they do. And so far, it has been lovely. The inflation that it has created has been the kind of inflation that almost nobody resents. It's called a bull market. And that inflation seemingly is absolutely separate and distinct from the possibility of those dollars seeping into life as we live it on Main Street and winding up at the checkout counter in the form of a higher cost of buying stuff. Well, maybe that's going to end. I think there's a chance that all of this so-called stimulus is going to finally express itself in the rate of rise in the consumer price index that will surprise everybody, especially the authorities in the Federal Reserve Board. This is a very, very unpopular, indeed obscure opinion, obscure because it has been utterly wrong for as long as it has been enunciated. But that's one of the potential surprises that awaits us, CPI that will not obey instructions and it rises much above the Fed's 2% target.
Okay, so you're heading into the territory that I want to conclude with here, and I want to be respectful of your time because you've already given us so much of it. So I guess the first question is where is all this headed? And you just mentioned that the Fed may actually succeed beyond its wildest expectations here in terms of trying to hit its inflation target. It may hit it and then go far beyond it. So in terms of just sort of what you see as most likely here, is it sort of an inflationary spiral from here, or is it a deflationary crash with overinflated markets?
Well, let me first reassert the truth that ought to be obvious, which is that we can know the present, we can only handicap the odds of events in the future. The future is a closed book. I have proved that to my readers, to their certainly their satisfaction over the years. But I would say that we're going to look back on this era and we're going to say, what did we expect? It took the federal government about 185 years from Alexander Hamilton to Ronald Reagan to amass the first $1 trillion of public debt. It took us the month of April, in the throes of the so-called stimulus attendant upon our pandemic, to generate the marginal $1 trillion in public debt. So the public debt describes an exponential function now. The Fed has produced a rate of rise in the money supply that, in the shape of M2, one of the broader measures, is up 25% or so year over year. The Fed's balance sheet is up 80-odd% year over year. The Fed says it wants to induce inflation. I mean, these things in the Fed would seem to be flying in the face of the gods. It's toying with the fates, it seems to me. And this does not resemble anything like macroeconomic analysis. I invite the viewers and the listeners to this program and say, well, what would we expect? Wouldn't we expect, especially when everyone's looking the other way, there's all this talk about deflation, all this talk about the absence of sufficient stimulus. So I'm saying that why not at least investigate the alternative possibilities? Energy stocks are trading at near all-time lows with respect to the broader market. I'm not going to prescribe in course of investment action. I think you have authorities in your show standing by that do a much better job of that. But all I'm inviting people to do is consider the seemingly impossible, but actually not at all impossible alternatives to the narrative that Wall Street is very happily spinning. That narrative being, let us buy bonds because 2% is going to be more than enough in this world of the perfect alignment of supply and demand and of the splendid foresight of our monetary masters. No, that might be true, but I'm saying the odds on that outcome, I think, are very low, and at least investigate the alternative. And with that, Adam, I will stop preaching.
Okay. Well, all right, putting you in the hot seat here for a second, if the debates were magically declared over and the country said, we want Jim Grant in charge, are there any policies that would be at the top of your list to start implementing? I think the first thing I would say, look, I'm the new Fed chairman, deal with it. And I would say that we have generated an economy that is very susceptible, very fragile to cyclical bumps in the road because there is so much debt. These companies are up to their eyeballs in it. That's why we can't lift rates. So my first job, ladies and gentlemen, as Fed chairman is to little frank talk about where we are. Now, what I am going to propose to you as Fed chairman is that we get back to treating interest rates, these critical prices in our capitalist system, as prices to be discovered in the marketplace and not imposed from on high. To that end, I'm going to withdraw any assurance that Wall Street might have hoped for that we are going to control rates. No, we're going to let supply and demand take rates up or down or sideways. We are going to take our thumb off the scale of our capital markets. And I am not going to guarantee you a direction for the movement in stock prices. They might go down. Everyone must look to his or her own risk tolerance and let us get back to the discovery of prices in the market and away from the administration of prices for the benefit, mind you, of those who don't need the benefit. That's my speech. Are you still happy you appointed me Fed chairman? Too bad. I'm here for 5 years. But I'm 74 years old, so there's always nature, Mother Nature. Don't despair, ladies and gentlemen. But I'm your Fed chairman. All right. Thank you, Adam. Yeah, thank you, Jim. That was great. Well, look, as we wrap up here, first again, thanks so much for taking so much time and giving us so many of your insights here. Just in parting, this isn't personal financial advice, but we have a lot of people watching this program who I think similarly to you and are definitely very inspired by your work and what you said today. What general advice or recommendations would you have to them? You mentioned looking for some of the things that are out of favor, like energy stocks. I know in the past.
Well, Adam, I'm going to demur a little bit on this. We have subscribers who pay what they think is a fancy price, what I know to be a most reasonable price for the specific ideas that we generate. And we're in the idea business. They say that the internet information wants to be free. No, mine doesn't. Mine wants to pay the rent. I will give you two examples. We've been looking, for example, in the very dry ground, this topsoil-free cropland of interest rates, and we have been finding some things to look at in closed and municipal bond funds that are trading at steep discounts to net asset value. We have been looking at some bank preferred stocks. So what we try to do is to look where others aren't, and we try to look for cheap things where there's a margin of safety. And
Great.
That's yeah. Okay.
That makes great
sense. Good to talk.
In a second, I'm going to ask where people can go to subscribe if they're interested. Before I do, one last sort of asset question, and it's just a general question, but it's an asset that's of strong interest to our viewership. And you've commented on it publicly where you said that you believe that gold has a bright future going forward, probably because of the concerns you just mentioned about inflation and continued monetary.
Yes. Let me say that, if I may say this about gold. Gold is money. It is meant to yield nothing. That is to say, it returns just as much as most bonds do with respect to income. Bonds these days, that is. But it's got no price earnings ratio. It is a speculative asset. I have, so old am I have in my lifetime, it's traded at $35, not traded, it has been pegged or has been legislated at $35 an ounce. I've seen it at 2,000, as we all have recently. I bought my first Krugerrand while standing in line, this is a rookie era, 1980, paying the top price of $850.
Wow.
I didn't get back to even for years. So this is not a risk-free asset, but I think that gold, the price of gold is a fine hedge against the depredations of our central bankers. And I believe it has a place in a portfolio, which should not necessarily dominate a portfolio. You buy it knowing that if things go right in the world, as things occasionally do, this could trade back to 1,000. And you don't want to be in the position of owning everything you have in the form of gold bullion if it happens that way. But yes, I believe that gold, the price of gold to me is the reciprocal of the world's faith and trust in central bankers. That faith and trust in my mind is misplaced. Therefore, I think that gold will do well, is an opinion. That's all it is. It's an opinion.
All right. Well, thanks so much for sharing that. And again, thanks so much for coming on, Jim. It's been wonderful. For people that want to follow you further, learn more about you and your work, potentially subscribe, where's the best place for them to go?
I'll just go to the website. They find in the yellow pages, Grant's Interest Rate Observer.
Great. And we'll put the URL up here on the screen so folks can get there easily. Jim, a real pleasure. Thank you so much.
Thank you, Adam.
At some point in the future. And again, thank you so much.
It's been a delight. Thank you.
Thank you, Jim.
All right, John and Mike, again, what a huge treat, the Jim Grant on the program. Anyways, guys, I'm sure you took a bunch of notes. Before I jump in with you guys, I just want to let our viewers know, Jim, before we got him on the program, he had some pretty major technical issues on his side, which at the very end, we fixed by having him call in to the Zoom video from his phone. So we know his audio wasn't perfect, but it was the best that we were able to set up during the circumstances. So anyways, thanks for your tolerance on that. But John and Mike, I always, when we bring on a big brain like Jim, I'm always sort of looking to see if there's kind of a hole in our worldview that they're able to fill that maybe changes our minds materially on any given subject. I'm not going to put words in your mouth. I'll let you respond. But I always continue to find myself surprised with how validating these guys tend to be for us. I'm always looking for somebody to say, hey, look, guys, you really don't need to worry as much about what the Fed is doing for new reason X, Y, or Z. I think Jim is just as concerned as we, if not more so. But I'm curious what you guys took away from it. John, let's start with you.
Yeah, no, Mike and I have followed Jim and his work for pretty much our whole careers. And he always strikes us as being a very thoughtful, well-reasoned and practical kind of observer. Frankly, the kind of people you want running an economy, frankly. I think everyday folks maybe that watch from home that aren't as in tune with the intricacies of the financial markets as he and perhaps we are, can just see that exude from him. And so not only is he an authority on a lot of the intricacies of financial markets, but he approaches things and observes things with a practicality and a logic that I think is largely lacking in kind of policymakers that we've given much control to. So I always appreciate his comments, and they always strike us as very balanced. He didn't come out bad mouthing or kind of touting one thing over another. Just about balance and kind of good prudence, frankly.
Yeah, crazy that somebody might actually recommend returning to a system based on true price discovery. It's just the foil of Jim's practicality versus the incredibly manipulated to the thumb on the scale system that he mentioned that we have today. Mike, how about you? What were some of the things that you took away from Jim there?
Yeah, I thought it was really refreshing, his suggestion that if he was the Fed chairman, that we would return to a market of two-way price discovery and truth. What's heartbreaking about this whole thing is that we're really not able to know the truth about the system and just how fragile the system is at this point. I mean, he's right. This is a multivariable system, and it really feels like we've pushed almost every variable to the ultimate limit. No one knows exactly what's going to happen, when it's going to break, if it's going to break. We know the data. We know that it should break. We know that the extreme hubris we see, if it doesn't result in some type of negative cost, it'll be the first time in history. And these central bankers have been unbelievably successful for much longer than any one of us, and I think probably Jim Grant would agree, could have ever dreamed they'd be successful. But we always fall back on the actual data. The valuations in the equity market are higher, literally, than they've ever been, higher than 1929, higher than 1999, higher than any other high in U.S. history by looking at data that's measurable and statistically relevant. And by statistically relevant, I say that this data predicts what's going to happen to market prices in the future. We're looking at probably negative, -2%, -3% maybe, returns in the S&P over the next decade. So it's a difficult place to be. As a manager, as an investor, we're continuing to be very, very safe and conservatively invested. We haven't changed too much. Every week we tell you what's happened in the market. Maybe we'll get to that again this week, but not much has happened to our allocation. Markets bounced a little bit this week, but not much else has changed.
All right, yeah, and let's talk about the markets in just a sec. But before we do, I just want to underscore that Jim it's hard to overemphasize how highly respected he is on Wall Street and how many large institutions subscribe to his interest rate observer. So when you have somebody who's got, his level of gravitas, his level of market experience, right? He mentioned he's 74 years old. He's been through, an awful lot of market ups and downs. He's also a financial market historian. So he's written books on previous, bubble eras, previous economic crises in the US and other countries that go back centuries. And when a guy like that says, hey, I think the level of speculation we're at today is right up there at the top of what we've ever seen, you've got to take notice. So to the folks that keep chiming in, and I understand why, in the YouTube comment section saying, hey, you guys, keep waving this warning flag about the markets, and yet they keep going higher. To Jim's point there, asset price bubbles are a lot of fun on the way up, right? And the key thing is just not to lose yourself in that. And we put up the chart of Newton in, I think it was probably 2 videos ago, where he showed even he got sucked in back during the South Sea bubble after having exited, making a lot of money, but he got sucked back in again, feeling like a fool, and then ended up losing everything in the resulting crash. So a huge part of these videos is trying to bring on very smart people. We're not cherry picking them for their point of view. We're picking them because they are experts in their field. And when they come on and tell you, this is a time to be cautious, guys, you really need to take that to heart. All right, so talking about the market action, Mike, you mentioned that the markets haven't done too much. I mean, they have gone up since last week. The S&P is up about 150 points. The NASDAQ's up about 850 points since last week. So it does seem, and we talked a little bit about this at the end of last week's video, that the 100-day moving average served as support, and virtually every index bounced off of that 100-day moving average and have been going up, at least in the past week. Now, a lot of that's been driven by speculation that a deal is coming soon on stimulus, and the markets have been kind of bouncing around with every headline. Stimulus looks positive, great. Stocks jump. Oh, it looks like maybe Pelosi saying she's not going to play ball. They drop down. That seems to be what's driving markets right now. But Mike, back to you. What do you guys take from this past week's action in the markets?
I wouldn't really read that much into it. It looks like we're up maybe 3-4% versus when we met last week. It looked actually a little bit more like 3%. It depends upon how you measure the last week. But gold and silver have bounced too. We really try not to read too much into the day-to-day headlines. This market's extremely richly valued, and it's still in what we think is this bounce from the March 23rd low. And yes, the S&P has reached new highs, the Dow reached new highs, the NASDAQ certainly reached new highs, but these highs are not that much higher than the previous highs. In fact, here with the S&P at around 3360 or 3370 at the close, it's right at the the level of that previous high. It's really not higher than it. Just the other day, we were at close to a 10% correction, and we bounced from there a few percent. But this market is kind of vacillating, in our view, around a large broadening top. The last high in January of 18, we topped out at, I think it was 2872, call it 2900. And then over the next couple of years, we had this giant megaphone pattern that you have showed a few times on the program, and we just went on whipping up and whipping down. And at the high, maybe we were 16 or 18% higher than that January 18 high. Then we had the March correction, the fastest in history, followed by the fastest bounce in history. Everyone got sucked back in, got complacent. What you may not know about this market is the Dow topped on September 3rd, a month ago. Just about a month ago, and so we're seeing still a very disparate market where different indices are topping and acting differently. But it doesn't feel, when I looked at the charts and then realized that, wow, the Dow topped well over a month ago, it didn't really feel like it, And I don't want to make any direct corollaries, but that reminds me, of course, of 1929, looking at the Dow there topped on August 30th, and it wasn't until a month and a half or a little more later, I think on October 19th of 29, that we rolled over and went down literally like 34%, and I think it's a couple of weeks. So still a very, very treacherous market. We remain very near net 0% exposed to the stock market. We're happy to see gold and silver and miners bouncing this week. And, we still think there's much better opportunity on the next leg down to enter the market in a very hedged way.
All right, John, feel free to add any perspective to what Mike said, but I also would love for you to comment on the fact that we just had, one of the biggest drops in the month of September for a number of years. We're now heading into October, which historically has been the riskiest month for markets. And of course, we've got a hugely potentially disruptive event coming up on the horizon, which is the presidential elections in early November. From the standpoint of there being, a November surprise or a contested election or whatever, are you guys girding yourselves up here for, the risk for potentially greater volatility coming in here and surprising folks?
Yeah, that's always a possibility, Adam. We always say that when you get to the kind of situation we're in now with these extreme valuations and extreme kind of tenuous markets, any catalyst will do, and certainly a presidential election that's uncertain and maybe even volatile, and coronavirus with unknowns in terms of what might come in terms of a new wave. Those are certainly viable catalysts, but it's kind of misses a bigger point that, and I really like the way that Jim Grant, our guest today, kind of put it in the context of folks and the kind of paradox of low interest rates has caused folks to do the math in their own minds that, hey, if I can only get X% very low return on my money, I need a lot more of it so in effect, hoarding or saving rather than spending as the policymakers might be. But that, these markets and the day-to-days are really missing the point that folks we work for, our clients and talk to, they know that their goal is not to track the markets on a day-to-day basis, but to make sure their financial lives are secure. And it's not easy to do to as humans to tune out the day-to-day, but that's certainly what we are here to do, to help make sure they can kind of look at things in context of where we are in this vicious extreme cycle, and really put into context what this means for the likelihood of their future lives and security. Sure, you can play in these markets. They're fun, as Jim used that verbiage, but losing 40 or 50 or 60% of one's savings isn't fun, because you don't get a do-over. At least most of our clients don't. And you betcha that's what the data certainly paints as a very possible and maybe even likely picture. So we always got to ground ourselves in the data and the data that matters for our clients and what we're here to do for them.
Great. So just bringing things to an end here, given where we are time-wise, to your last point there, John, about really looking at capital preservation during a time that could be even more volatile than what we've seen in the month of October here, or September here. We've got the Peak Prosperity Conference coming up. We do a conference annually. We're doing it digitally this year because of COVID. We've mentioned on the program here once or twice, but I'll put up the URL for it right now. We've got a number of great speakers that are going to be speaking on similar topics, but all about the risks that we've talked about here with Grant, but also not just the risks, but hey, what steps should you consider taking to preserve capital, and maybe if there is some sort of corrective event, to then seek prudent growth after that, right? We're going to have folks like Mike Maloney and Grant Williams and Sven Henrik and Danielle DiMartino Booth and Axel Merck and John Rubino and Charles C. Smith and a whole bunch of others. But we're going to have you guys there as well. And you guys will be available in the Money Q&A panel that we run there, which is we take an hour, we let the audience just ask literally any questions they want to about how to invest, things that they could be doing with their money, things they should be doing given their personal financial situation. And we get you guys and a few other domain experts there, estate law, taxes, et cetera, real estate investing, answering as many questions as we can. It's hugely valuable. It's always a hugely appreciated part of these seminars, but we're also going to have you guys there making yourselves available to give free personal financial consultations to folks. We mention those every week on this program, but you guys are going to be giving, I think you're going to have a certain number of slots. I don't know if the final number's been nailed yet, but where people will be able to step out for a half hour from the main conference and get to meet with you two individually and go through their personal financial situation and say, okay, John and Mike, given where I am, what things should I be considering? Where am I vulnerable? What might be some smart steps to take from here? So I just want to let folks know that that's coming. And with that said, guys, thanks for doing everything that you do week after week for all the people that we send you and helping answer and address their questions. I know that for the seminar there, you guys will be offering some initial thoughts too about, or not initial thoughts, but your thoughts on, hey, if you want to sort of volatility proof your portfolio, given the upcoming election, here are some strategies that can kind of color your risk, at least for that time being. Anything you guys want to mention about that before I wrap things up here?
Adam, I guess I just want to say thank you for having us every week. We appreciate the work you do in putting these together, and it's us that is grateful for the great people we talk to, the new people and the existing clients. So I just wanted to say thank you.
Well, thanks. It's a love fest all around. Huge thanks as well to our viewers by liking these videos. And if you haven't liked this one yet, folks, please do. But by liking these videos, sharing them, getting the great feedback that we've been getting, we've been able to go out and get higher and higher caliber guests. And getting a guest like Jim Grant is a massive coup. And there are others whose doors we're knocking on that the fact that we got Jim is really going to help going forward. So anyways, let's keep this virtually supportive and what do I call it? Virtuous cycle of us all supporting and appreciating each other going. All right, so last thing is I do every week. If you want to find out who's coming on future programs, follow me on Twitter. That's @MenloBear. And I share who's coming up and also love to get your feedback on other guests that you'd like to see. And you don't have to wait until the conference to have a personal financial consultation with Mike and John and the team at New Harbor. Mike and John, I will put up the Greylock URL on the screen here whenever you guys are talking. So if folks want to find out how to work with you guys, they can go to that URL, or you can just stick around to the end of this video, folks. We go through all the instructions on how to schedule one of these free consultations with the guys at New Harbor. And quick note, there's zero commitment to work with them. There's no strings attached. It's just a public service that they and we have worked out. So with that said, guys, another phenomenal week, phenomenal guest. We'll keep watching to see what these markets do, and viewers will keep you updated on how our perspective of the markets might be changing as they change in real time. But if we can underscore one thing, which Jim Grant did way better than I can, it is a time for prudence. And so if you don't feel that your personal financial situation is well prepared for volatility or some sort of shock, then make sure you schedule an appointment with a financial advisor who recognizes these risks and can appropriately put together a strategy for you. If you've already got a good advisor, work with them, but if not, consider working with the guys here at New Harbor, at least having that initial free talk with them. But with that said, guys, we'll see you next week. Take care, John. Take care, Mike.
Thanks, Adam. Have a good one. We'll see you.
Thank you, Adam. See you next week.
All right, guys, take care. If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.